Hello, everyone. My name is Doug Pless. I'm a full-time trader and a SpotGamma content contributor. This presentation is a case study that shows how to use a variety of SpotGamma tools to find, plan, and execute a trade in a stock. The stock selected for this case study is Meta on April 4th. I have a two-step process for trading. The first step is planning. I use positional analysis. I look at how traders and market makers are positioned in the options market and how those positions change from day to day to develop a thesis regarding the expected trading range and volatility for the day, as well as the directional bias. The second step in my process is execution. I watch how price reacts at key gamma levels, real-time order flow, and real-time market maker hedging flow to confirm my thesis. And for setups, let's look at how I use this process to get from planning to execution. The setup that I will cover is based on the positional analysis of Meta. The setup can be taken with shares of stock, options, or option spreads. And position duration or time frame could be intraday or longer. And for this case study, my instrument is stock shares and my approach is intraday, meaning I plan to exit the position before the end of the day. Here's my agenda for this presentation. First of all, I want to go over a brief company overview. Then I'll go over my planning process, how I use SpotGamma tools for positional analysis, and how I develop a thesis. Next, I'll cover trade execution for this case study. Then I'll go over some alternative trades using options, and then I'll cover the key takeaways for the case study. First, here's a company overview. Everyone is probably familiar with Meta. It's one of the Magnificent Seven stocks. That's Apple, Amazon, Google, Meta, Microsoft, NVIDIA, and Tesla. Meta's in the technology industry and the communication services sector. Meta Platforms is the parent company of Facebook, Messenger, Instagram, WhatsApp, and Meta Horizons. Most importantly for traders, Meta is a very liquid stock that has very active options. For my planning, I look at the following data. I look at the SpotGamma key daily levels and how they change from day to day. Are traders looking for, accepting, and positioning themselves for lower or higher prices? For example, if the put wall and call wall move higher, this indicates traders are looking for, expecting, and positioning themselves for higher prices. Also look at charts in Equity Hub. I look at graphs that show the key gamma levels and how gamma changes with price. Also look at the HIRO chart, and that is technically part of my execution process. Before discussing this case study, let's briefly look at some background information and an explanation of these levels and charts. First, I look at the key daily levels. These are updated daily. They're available in Equity Hub. They're proprietary to SpotGamma. The key gamma strike is the strike with the largest total absolute gamma position. The hedge wall is the level where the largest gamma change in gamma is detected. It is considered a major support and resistance level. The call wall is the strike with the largest net positive gamma. It can act as resistance, since market makers will most likely have to increase delta hedging at this level. The put wall is the strike with the largest net negative gamma, and it can act as support. For more information about these levels, please take a look at the SpotGamma Support Center. There are a variety of charts available in Equity Hub, all proprietary to SpotGamma. There are two key charts that I look at. First, the composite view chart, shown on the left, shows the rate of change of gamma at different price levels. A high SG momentum indicator indicates gamma changes more rapidly at that price level. It also indicates higher expected volatility. The SG momentum indicator is shown on the vertical axis, and strike price is shown on the horizontal axis. The put and call impact chart on the right shows the amount of put and call gamma at different price levels. This chart provides a clear visual representation of the put versus call domination at different price levels. And the steepness of the lines also shows the rate of change of gamma. The steeper or more vertical a line, the higher the rate of change of gamma and volatility at that level. Also look at the HIRO chart, that is hedging impact of real-time options. This is also proprietary to SpotGamma. Again, this is technically part of my execution process. The SpotGamma HIRO indicator shows the market maker hedging impact of options trades in real time. Market maker hedging flow can have a significant impact on price. This chart shows calls and puts separately. The white line is price, the orange line is calls, and the blue line is puts. A rising orange line indicates traders are buying calls. A rising blue line indicates traders are selling puts. SpotGamma provides several different ways to find stocks to trade. I like to trade large cap tech stocks like the Magnificent Seven stocks, so I have a watch list in the SpotGamma dashboard. You can also use scanners in Equity Hub. You can find trending stocks in HIRO or rank stocks by HIRO signal. All right, let's move on to the case study. These two tables summarize the SpotGamma key daily levels for this study that were shown in Equity Hub on April 3rd and 4th. Green numbers on the right table indicate the value increase from the previous day. This table on the right shows the hedge wall, call wall, and put wall moved higher from the previous day. The data in the tables in the previous slide comes from the 10-day history in Equity Hub. The 10-day history shows the changes in key daily levels and other metrics for the last 10 days. Note this screenshot was taken on April 8th. That is the following Monday from the date of the case study. The history for Meta showed a move higher in the hedge wall, call wall, and put wall on April 4th compared to the previous day. This indicates the potential ceiling and floor moved higher, and traders were looking for, accepting, and positioning themselves for higher prices. The put and call impact chart for Meta from Equity Hub showed more call notional gamma, that is the orange curve, then put notional gamma, the blue curve, above the 500 key gamma strike. That's the line in the middle of the chart with the largest orange and blue vertical bars. This indicates that calls were driving the price action for Meta above 500. Below 500, calls and puts were about equal. The chart showed that call and put notional gamma would change quickly between around 470 and 530. That's where the blue line and the orange line were the steepest. It also showed that call notional gamma, that's the orange vertical bars, was dominant above the 500 key gamma strike. Call notional gamma and put notional gamma, that's the blue vertical bars, were about equal below 500. Based on this information, the shifts in the key gamma levels, and the graphical views of gamma, I develop a thesis for the day. Here's my thesis for this case study. First, I was looking for high volatility. That's based on the high rate of change of call and put notional gamma between around 470 and 530, shown on the put and call impact chart. Also had a bullish directional bias that was based on the shifts higher in the hedge wall, call wall, and put wall. Bottom line, I was looking for a higher volatility day. I was looking for long entries in Meta. I plan to watch the HIRO signal at the open for an indication that traders were taking positive delta positions. Also watch flow alerts to signal significant options activity, and watch reactions at key daily levels to confirm my thesis and for potential trading opportunities. On Thursday, April 4th, Meta gapped up and opened at 516.42, above the 510 call wall. Traders immediately began buying calls and selling puts, calls shown by the rising orange line, labeled 2A, and puts shown by the rising blue line, labeled 2B, in the HIRO chart. When traders buy calls and sell puts, market makers take the opposite side of the trades and sell calls and buy puts. Since market makers want to remain delta neutral, they had to buy stock to hedge their delta exposure. In addition, a flow alert signaled significant options activity immediately after the open, shown in the HIRO chart with label 1. This alert got my attention, and the rising call and put lines were a signal to look for long setups. After a quick move higher at the open, Meta chopped up and down for about an hour. Around 10:35 a.m. Eastern Time, traders resumed buying calls and selling puts. At that time, both the call line and put line began moving higher at the same time. When both the call line and put line move in the same direction, this is a very powerful directional indicator. In this case, the signal was bullish. Meta continued to move higher while traders were buying calls and selling puts. At around 12:40 p.m. Eastern Time, traders stopped buying calls and started selling calls, shown by label 6 on the chart. This was the signal to exit any remaining long positions. This was also a good time to consider a short or bearish position, since Meta was trading well above the call wall, which usually acts as a ceiling for price. The order flow for Meta is shown in this Bookmap chart. The volume dots on the chart show market buy minus market sell orders. Green volume dots indicate more buyers than sellers. Magenta dots indicate more sellers than buyers. The heat map on the chart shows a history of the limit orders in the order book. Dark orange and red lines indicate a higher number of orders. These are levels of high liquidity. Orders above current price, are limit sell orders. These orders can act as a magnet for price. The reversal higher at 10:35 a.m. Eastern Time is shown with the second label 3 on the chart. After the reversal higher, Meta made a series of higher lows and highs. Traders continue to buy calls and sell puts. Market makers bought stock to hedge their delta exposure, and aggressive buyers moved Meta up to the final target at the 530 liquidity level, and that is the second label 5 on the chart. Potential long entries are shown in the Bookmap chart with label 3. The day played out as expected. Higher volatility with a bullish bias. The hedging flow for the entire day is shown on the HIRO chart, and the price action is shown on the Bookmap chart. When traders stopped buying calls and selling calls at around 12:40 p.m. Eastern Time, Meta consolidated between 528 and 530. Meta began to move lower when traders started buying puts around 1:15 p.m. Eastern Time. This was a great time to enter a short position. Traders were selling calls and buying puts, and Meta was trading above the 510 call wall. Meta dropped for the rest of the day as traders continued to buy puts. Meta closed at 510.92, just above the 510 call wall. With the stock closing right above the call wall, this could have served as an end-of-day exit point if you shorted the stock around 528 when the HIRO flows reversed. There were several ways to play the move higher with options, including buying a call, selling a put, buying a call spread, or selling a put spread. Here are the key takeaways for this case study. First, the shifts higher in the hedge wall, call wall, and put wall provided a strong basis for a bullish directional bias. The HIRO flow alert provided a timely alert to signal significant options and hedging activity and drew attention to Meta for potential trading opportunities. HIRO provided a clear signal that traders were taking positive delta positions, buying calls and selling puts, and market makers were buying stock to hedge their delta exposure. The reversal of options hedging flow from positive delta to negative delta from around 12:40 to 1:15 p.m. Eastern Time clearly marked the high of the day. And finally, after the midday reversal and hedging flow, price reversed lower back down to the call wall at the end of the day. That wraps up this case study. Thank you very much for watching.